So I'm going to be talking today about the noisy market that we're seeing out there. What do we mean by noisy market? We're seeing a lot of tweets, we're seeing a lot of headlines, we're seeing a lot of macro news dominate the direction of the market. We're going to talk about the distortions that this is creating in the market and some of the opportunities that we're seeing. So I thought a great place to start would be a recap of the S&P 500 and the one-year performance. Now let's look at how noisy it's been over the last 12 months. The market's had everything thrown at it. We've had tariffs escalating. Next month, they're de-escalating. We've had numerous wars occur. We've had maximum geopolitical uncertainty in the last 12 months. And then recently, we've had to deal with the big Trump beautiful bill. And look at where we are. The US market is on all-time highs, and so is the Aussie market as we stand here today. Trump even called it pretty well back on April 10th, when he said it was time to buy US stocks, and we've ripped back nearly 20% since then. Australian market's done very similar. So what does this all tell us? It tells us two things. Trying to trade the macro and the noise is extremely difficult. And number two, it tells us that timing the market is nearly impossible, and it's all about time in the market. Now, we at Solaris, we get a lot of comfort that as we tune out of the noise and look at the longer term, let's have a look at the S&P 500. It's up a very credible 510%, 520 over the last 25 years. And then we overlay that with earnings of US companies. And we see that high correlation between fundamentals, and the best gauge of fundamentals is earnings and profits, and what the share prices in the US market has done. So that's where we concentrate. Now, what do we think at Solaris is important when we're talking about fundamentals? Well, we put each stock in the ASX 300 through our investment process. And that includes a rigorous qualitative assessment, followed by a rigorous quantitative assessment. Every stock in our core fund, our long-short fund, and our income fund goes through this same process. Now, there's a couple of points I wanted to call out. Industry structure, that is the most important assessment that you can make on a company before you invest, because that will dictate future margins, future growth rates, and its competitive advantage. So what are we assessing? We're looking at Porter's 5 forces. We're putting each stock through that model. We're also looking at competitive advantage. How endurable do we think their competitive advantages? Do they have good pricing power today? Will they have good pricing power into the future? Another important assessment is trend in ROE. It's important. It's not exactly absolute ROE, whether it's 12% or 18% or 10%. It's what does that ROE look like throughout the forecast period? Is ROE trending up in the next 3 years, or is it trending down? Next up, once we go through the qualitative assessment, we'll look through a detailed quantitative assessment. So we'll be doing detailed modelling on each company that goes into the portfolio. And what we're trying to discover in that is an earnings or valuation inefficiency. So let's bring this to life, and we'll go through some examples. Let's have a look at Wesfarmers. Now, we're talking about a noisy market. Have a look how this share price here has diverted from earnings and fundamentals. It's gone from a PE in the low 20s up to 33 times PE today. Now, what's driven that? We put that down to a couple of things, including flows and positioning. Well, lots been said in the media about the move from active into passive, and we think that Wesfarmers has been a beneficiary of that. What we've also seen in the market in the last 6 months is offshore buying coming into the Aussie market. And that's because Australia has been viewed as a relative safe haven. With what's going on with the geopolitical uncertainty in China, US and Europe, there's been money trying to find a relative safe haven in Australia. Now, typically that money will target the ASX 20 in blanket buying, but that's not what we're seeing. That money's coming into Australia and it's being very targeted. It's targeting CBA, Wesfarmers, Telstra, Brambles and JB Hi-Fi. They've been very big beneficiaries of this offshore flows. But let's have a look under the hood and find out what's going on at Wesfarmers on a more fundamental. Now, I know we all like going to Bunnings on the weekend and enjoying the sausage sizzle, but there's no sizzle in that Bunnings EBITDA at the moment. In the last 6 months, earnings is flat. That business is becoming more mature. Management can see that. They're allocating less capital to Bunnings at the moment, and they're slowing down their store rollout because the market is becoming saturated with Bunnings. And the growth opportunity is not like it was 5, 10, 15 years ago. Let's have a look at Kmart. Kmart's actually doing pretty well. EBITDA is up 6%, earnings changes 2% in the last 6 months. Now, I know my kids love going to Bunnings, and I'm a dad, and I don't mind going to Kmart. I like going to Kmart too because it's relatively quite cheap. They've revamped their products and they're doing pretty well. Let's have a look at Officeworks. Well, Officeworks had a very big pull forward in EBITDA during COVID, and it's still suffering today. Its EBITDA's down 2%. Now, a large part of that chemicals division is lithium. Earnings, EBITDA's down 15% in that lithium in the last 6 months, as we've seen the lithium price collapse. And lastly, their industrials and safety division's been under pressure as well. Small division, but EBITDA's down 26% in the last 6 months, earnings changes on the back of softer demand downstream. So that share price is up 26% in the last 6 to 7 months on negative earnings changes. We see a huge disconnect there. We're putting that down to market noise, and we're not seeing any fundamental value in Wesfarmers here. But where are we seeing opportunities? Let's have a look at A2 Milk. The big growth driver in A2 Milk is their opportunity to sell infant formula into the China market. And what we're seeing in China is a real turnaround in the economy up there. We've been up there 4 times in the last 12 months and been watching this turnaround very closely. Now, China, after a long period of property price declines and share market declines, back in September last year, they started to stimulate. And their idea was to stabilise both those asset classes. We can see tier 1 property prices, tier 1 city property prices in China now stabilising, and in some instances inflecting up a little bit. And we're also seeing the share market in China up 20 to 25% from the lows. So this is providing a lot more wealth effect amongst the Chinese consumers. And A2 Milk is a very big beneficiary. They sell high-end infant formula into the Chinese product. So as a China consumer is happy to pay a bit more, we can see A2 Milk taking market share in that market. The other important piece to point out is birth rates have hit a small inflection point and stopped falling in China at the moment. And all that stimulus that has been directed is assisting that. Now, we think they're priced very well. They're on a PE of 25 times, and we see earnings growth of close to 20% each year in 26 and 27. They've got a great balance sheet. Management's executing very well, and it's a stock that we hold across all 3 of our portfolios. Even our income fund, despite this stock only having a 1% dividend yield, because our income fund has a dual mandate for dividend yield, but also capital growth. Now, Cettire is a stock that we put through our investment process 2 years ago. And shortly after putting it through our investment process, we initiated a short position in our long-short fund. This stock in the last 5 years IPO'd at 40 cents. It went all the way up to $5, and it's now back at 30 cents today. We've had a lot of concerns around their industry structure, which we didn't think was viable or sustainable on the long term. We saw Farfetch, which was a direct competitor to them in the US market, go bust in 2023, and management have sold $350 million worth of stock. So we saw a lot of red flags. Their accounting was very aggressive, particularly around their revenue recognition. Now, we've recently closed a short in Cettire. It's trading at 30 cents today, but we do fear they are in need of further capital. So we've seen a lot of short-term divergences in the market, and that is driven by what we call noise. We don't try and trade the noise. We look at the long-term fundamentals, and we believe when you look out over the next 1, 2, 3 years, that's where the true alpha can be found. And we're seeing a lot of opportunities out there in the Aussie market, and A2 Milk is one of the stocks we really like at the moment. We are renowned for our consistency of performance and have outperformed in 18 of the last 25 years and are very highly rated by the ratings agencies. Thank you.